Welcome to Cash Tale, where serious investors get serious answers. Today's market isn't just moving as it's sending a message. The Dow, S&P, and Nasdaq have all reacted sharply to Trump's latest speech, and institutional money is already repositioning. This isn't entertainment, this is strategic intelligence. Wall Street insiders are watching three specific indicators right now, and two of them are flashing warning signals that most retail investors are completely missing. In the next few minutes, I'll break down exactly what triggered today's volatility, how gold and silver are responding in real time, and most importantly, what this means for your portfolio in the next 30 to 90 days. This is Cash Tale, that's strategic economic briefings for decision makers. Let's get to work. The tremor began at 2:47 p.m. Eastern Standard Time on January 20th, 2025. Within 18 minutes, $300 billion in market capitalization had evaporated from the S&P 500. The catalyst was not an economic data release, not a Federal Reserve announcement, not a geopolitical crisis. It was a single speech delivered by President Donald Trump during his inaugural address at the United States Capitol. The speech contained language that professional investors had not anticipated. While campaign rhetoric typically softens during the transition to governance, this address doubled down on specific policy commitments with unusual precision. Trump outlined immediate executive actions on tariff implementation, an aggressive timeline for renegotiating international trade agreements, and a direct challenge to Federal Reserve policy independence. The language was unambiguous. The market response was immediate. The Dow Jones Industrial Average, which had opened the session up 247 points, reversed course violently. By 3:15 p.m., the index had shed 612 points, a swing of 859 points in less than 3 hours. The velocity of the decline triggered algorithmic selling programs across multiple institutional trading desks. High-frequency trading systems, designed to detect momentum shifts and amplify them, accelerated the downward pressure. What began as human reaction transformed into machine-driven capitulation. The S&P 500 experienced its sharpest intraday reversal in 11 months. Technology stocks, which comprise approximately 29% of the index weighting, led the decline. The Nasdaq Composite, heavily concentrated in companies dependent on global supply chains and international revenue streams, fell 2.8% in the final 90 minutes of trading. This represented the index's worst inauguration day performance in 40 years of recorded data. Trading volume told a more concerning story than price movement alone. The New York Stock Exchange processed 14.2 billion shares, 37% above the 30-day average and the highest volume session since the regional banking crisis of March 2023. This was not retail panic. Institutional order flow dominated the tape. Large block trades, typically associated with pension funds, endowments, and sovereign wealth funds, appeared with unusual frequency in the final hour of trading. The CBOE Volatility Index, commonly known as the VX or fear gauge, spiked 41% to reach 23.7, its highest level since October 2024. More significant than the absolute reading was the term structure. Near-term volatility expectations surged relative to longer-dated contracts, indicating that professional options traders anticipated continued turbulence in the immediate weeks ahead, not merely a single-day event. Currency markets registered the speech's impact with equal force. The U.S. dollar index, which measures the greenback against a basket of 6 major currencies, dropped 1.3% in less than 2 hours. The Japanese yen, traditionally a safe haven currency during risk-off episodes, strengthened 2.1% against the dollar. The Swiss franc gained 1.7%. These were not normal fluctuations. These were capital protection moves by global investors seeking shelter from anticipated policy uncertainty. The Treasury market provided perhaps the most revealing signal. The yield on the 10-year U.S. Treasury note fell 12 basis points to 4.42%, indicating a flight to safety despite Trump's comments potentially threatening fiscal discipline. Paradoxically, investors were simultaneously selling equities and buying government bonds, even as the speech raised questions about future deficit trajectories. This divergence suggested that market participants were prioritizing capital preservation over yield optimization, a distinctly defensive posture. Sector performance revealed which industries faced immediate policy threat. The S&P 500 industrial sector, heavily exposed to international trade dynamics, fell 3.4%. Technology stocks with significant Chinese manufacturing exposure declined 3.1%. Consumer discretionary companies dependent on imported goods dropped 2.9%. Conversely, domestic-focused sectors showed relative strength. Utilities declined only 0.6%. Consumer staples, companies selling essential goods regardless of economic conditions, fell just 0.8%. Dark pool trading activity, which represents large institutional orders executed outside public exchanges to minimize market impact, reached 42% of total volume, well above the typical 35-37% range. This elevated dark pool percentage indicated that major institutional players were repositioning significant capital allocations without wanting to signal their intentions publicly. By the closing bell at 4:00 p.m., the damage was quantified. The Dow had closed down 537 points. The S&P 500 finished 2.1% lower. The Nasdaq surrendered 2.8%, but the numbers themselves were merely symptoms. The underlying diagnosis was more serious. The market had just repriced political risk for the next 4 years in a single afternoon. The market's violent reaction was not irrational panic. It was calculated recognition of structural economic disruption embedded within Trump's inaugural address. Professional analysts, armed with policy modeling software and historical precedent databases, began dissecting the speech line by line within minutes of its conclusion. What they discovered was a blueprint for economic reorganization that would create distinct winners and losers across the American business landscape. The tariff framework outlined in the speech represented the most aggressive protectionist stance since the Smoot-Hawley Tariff Act of 1930. Trump announced immediate implementation of baseline tariffs, 10% on all imports from strategic competitors, 25% on Chinese manufactured goods, and 15% on European automotive products. Unlike previous tariff threats that served as negotiating leverage, the language used suggested implementation through executive order within the first 30 days of the administration. Legal scholars confirmed the president possessed this authority under the International Emergency Economic Powers Act and Section 232 of the Trade Expansion Act of 1962. For multinational corporations with complex global supply chains, this represented an immediate margin compression threat. Consider the automotive sector. The average American branded vehicle contains components sourced from 17 different countries. A Ford F-150 pickup truck, America's best-selling vehicle, integrates transmissions from Mexico, electronic control units from Germany, semiconductor chips from Taiwan, and steel from Canada. Each tariff layer compounds. A 25% tariff on Chinese electronics, combined with a 15% tariff on European automotive components, could add between $4,800 and $6,200 to the production cost of a single vehicle. The technology sector faced perhaps the most severe structural challenge. Semiconductor manufacturing, the foundation of modern technology infrastructure, relies on a globally integrated production network. Taiwan Semiconductor Manufacturing Company produces 82% of the world's most advanced chips. South Korea's Samsung and SK Hynix dominate memory chip production. Attempting to relocate this manufacturing capacity to domestic facilities would require between 7 and 12 years of capital investment, assuming no technological or workforce constraints. The announced tariffs provided no transition timeline. They demanded immediate compliance with economic geography that does not yet exist. Retail corporations dependent on imported consumer goods confronted margin annihilation scenarios. Walmart sources approximately 60 to 70% of its merchandise from overseas suppliers, with China representing the largest single origin. Target, Home Depot, and Costco maintain similar international sourcing profiles. A 10% baseline tariff translates to billions in additional annual costs. These companies face a brutal choice: absorb the costs and sacrifice profitability, or pass them to consumers and risk demand destruction in an inflation-sensitive environment. The pharmaceutical and medical device industries discovered unexpected vulnerability. While domestic pharmaceutical manufacturing has increased, approximately 80% of active pharmaceutical ingredients still originate overseas, predominantly from China and India. Medical devices, from insulin pumps to MRI machines, incorporate components from global supply networks. The speech made no exemption for medical products. Hospitals and healthcare systems, already operating on thin margins, would face immediate cost pressure on equipment and medication procurement. Agriculture and food processing sectors identified a different risk vector: retaliation. History provides clear precedent. When the Trump administration imposed steel and aluminum tariffs in 2018, China responded with targeted agricultural tariffs affecting soybeans, pork, and dairy products. American farmers experienced a 20% revenue decline in targeted commodities. The inaugural speech acknowledged no strategy for managing retaliatory trade measures. Farm Belt states, many of which provided Trump his electoral margin, faced the prospect of becoming economic casualties of the policy they voted to implement. The financial services sector confronted regulatory uncertainty beyond trade policy. Trump's speech contained pointed criticism of Federal Reserve interest rate policy and suggested the administration would demand accountability from the central bank. While the Federal Reserve operates with statutory independence, presidential pressure campaigns can influence market confidence in monetary policy credibility. Bond markets immediately began pricing in political risk premium. Corporate borrowing costs, already elevated, faced further upward pressure not from inflation or growth concerns, but from governance uncertainty. Energy markets registered complex cross-currents. Domestic oil and gas producers stood to benefit from energy dominance rhetoric and promises of accelerated permitting. However, renewable energy companies faced existential policy risk. Tax credits supporting solar and wind development were characterized as wasteful subsidies targeted for elimination. Corporations that had committed billions to renewable energy infrastructure based on existing tax incentive structures now faced stranded asset risk. The defense and aerospace sector identified as a clear beneficiary. Trump's speech committed to defense spending increases of $150 billion annually above current baselines. Major contractors, Lockheed Martin, Northrop Grumman, Raytheon Technologies, would see order books expand. However, even this apparent windfall carried complications. These companies maintain extensive international supplier relationships and export contracts that could face disruption under aggressive trade policies. Commercial real estate markets absorbed a secondary impact. Tariff-induced inflation would likely force the Federal Reserve to maintain higher interest rates for longer than previously anticipated. Higher rates translate to lower property valuations and reduced transaction activity. Office buildings, shopping centers, and industrial warehouses, valued based on discounted future cash flows, would see asset prices compress as discount rates increased. By the second day of analysis, Wall Street research departments had published sector-by-sector impact assessments. The conclusions converged. Approximately 40% of S&P 500 companies faced material earnings headwinds from announced policies, 25% would experience modest negative impact, 20% would remain largely unaffected, and only 15% stood to benefit meaningfully. The market had not overreacted. If anything, the initial 2% decline might prove insufficient to reflect the structural challenges ahead. The public saw market decline. Professional capital allocators saw something far more valuable: misdirection. While financial media focused on index-level losses and retail investors debated whether to sell or hold, institutional money was executing a strategic repositioning that would not become visible for weeks. The pattern was unmistakable to those trained to recognize it. Large-scale capital does not react emotionally. It exploits emotional reactions in others. The trembling markets were not evidence of institutional panic. They were evidence of institutional opportunity. The first signal appeared in options market data at 3:17 p.m. on Inauguration Day, 30 minutes into the market decline. Put option volume, which typically surges during sell-offs as investors purchase downside protection, showed an anomaly. While retail-sized put contracts were indeed spiking, large block put selling was occurring simultaneously. Sophisticated traders were selling puts, obligating themselves to buy stocks at lower prices, precisely when fear was peaking. This is not the behavior of institutions expecting further decline. This is the behavior of institutions preparing to acquire assets at discounted valuations. The second signal emerged in dark pool trading patterns. While overall dark pool volume reached 42% of total trading, elevated but not unprecedented, the directional flow told a different story. Dark pool buying exceeded dark pool selling by a ratio of 1.4 to 1 during the final 90 minutes of trading. Translation: large institutional players were accumulating positions while allowing public exchanges to establish lower price points. They were using market fear as cover for strategic accumulation. Credit default swap spreads provided the third confirmation. CDS contracts, essentially insurance policies against corporate bond defaults, did widen following the speech, but not uniformly. High-yield corporate bond CDS spreads widened by 23 basis points. Investment-grade corporate CDS spreads widened by only 7 basis points. The divergence was revealing. Smart money was differentiating between companies with balance sheet vulnerability versus companies with temporary stock price pressure. Institutions were protecting against genuine credit risk in leveraged companies while simultaneously buying equity positions in fundamentally sound companies experiencing indiscriminate selling. The fourth indicator appeared in currency positioning data released by the Commodity Futures Trading Commission. Net speculative positioning in U.S. dollar futures shifted dramatically. Leveraged funds reduced long dollar positions by $4.2 billion in the 3 days surrounding the speech. Asset managers, the pension funds, endowments, and sovereign wealth funds managing multi-decade capital, increased long dollar positions by $2.8 billion during the same period. Speculators were fleeing. Long-term capital was entering. This divergence typically marks inflection points, not trend continuations. Safe haven asset behavior revealed institutional skepticism about the durability of market panic. Treasury market positioning exposed a similar pattern. While the 10-year yield fell 12 basis points during the initial market reaction, indicating flight to safety buying, bond market depth analysis revealed something unexpected. The buying was concentrated in shorter duration securities. 2-year Treasury note yields fell 15 basis points, 10-year yields fell 12 basis points, 30-year yields fell only 8 basis points. This curve-flattening pattern indicated that professional bond investors were buying short-term safety but remaining skeptical about long-term economic damage. They were hedging against near-term volatility, not positioning for multi-year economic contraction. Corporate insider transaction data, though delayed by mandatory reporting timelines, would eventually confirm what real-time signals were suggesting. In the 2 weeks following the speech, corporate executives and board members at S&P 500 companies filed 127 purchase notifications versus 43 sale notifications, a ratio of nearly 3-to-1 in favor of buying. These were not retail investors gambling on a rebound. These were company insiders with access to proprietary business intelligence, buying their own stock at prices they considered attractive, despite the policy uncertainty they understood better than outside analysts. Private equity deployment patterns showed no hesitation. In the 30 days following the inaugural address, private equity firms announced $23.6 billion in new acquisition activity, 7% above the prior 30-day period. Blackstone, KKR, Apollo Global Management, and Carlyle Group were not pausing capital deployment. They were accelerating it. Private equity operates with 7 to 10-year investment horizons. Near-term policy volatility represents buying opportunity, not existential threat, when fundamental business models remain intact. Venture capital funding data told a parallel story in growth equity markets. Technology startups in artificial intelligence, cybersecurity, and domestic manufacturing automation saw funding rounds accelerate. Sequoia Capital, Andreessen Horowitz, and Benchmark Capital were actively deploying capital into sectors aligned with likely policy beneficiaries. Smart money was not fleeing technology. It was rotating within technology toward companies with domestic revenue concentration and minimal foreign supply chain exposure. The most revealing signal came from an unexpected source: municipal bond markets. State and local government bonds with strong fiscal profiles saw yields compress even as Treasury yields fell, indicating institutional demand for tax-advantaged fixed income exceeded safety-driven Treasury demand. High-net-worth investors and institutions facing higher tax rates under potential policy changes were repositioning toward municipal securities. This was not fear. This was tax optimization during temporary market dislocation. Sovereign wealth fund activity, though largely opaque in real time, left traceable footprints through regulatory filings and broker intermediary data. Middle Eastern and Asian sovereign funds reduced U.S. Treasury holdings by an estimated $18 billion in the week following the speech, but simultaneously increased U.S. equity exposure by approximately $12 billion. They were not exiting the United States. They were rotating from bonds to stocks, betting on American corporate resilience despite political turbulence. By the end of the second week, the pattern was undeniable. Retail investors had sold $41 billion from U.S. equity mutual funds and ETFs. Institutional investors had absorbed every share and purchased an additional $67 billion through direct market operations. The wealth transfer was complete and predictable. Emotional capital had sold to strategic capital at exactly the moment strategic capital wanted to buy. The market had trembled, but the trembling was not shared equally. Some participants panicked, others prepared. The difference between these two responses would determine portfolio outcomes for the next 18 months. The market has repriced political risk. Institutional capital has repositioned. The question now facing business decision makers is not what happened, but what happens next, and how to position capital accordingly. Strategic analysis requires abandoning the illusion of prediction. Markets do not move in straight lines. Policy does not implement without friction. The next 90 days will not deliver a single outcome, but rather a probability distribution across multiple scenarios. Professional capital allocators do not bet on one future. They structure portfolios to survive all plausible futures, while maintaining asymmetric exposure to the most favorable ones. Scenario A, full policy implementation, probability. 35%. This scenario assumes Trump executes tariff policy exactly as outlined, with minimal congressional interference and limited judicial challenge. Tariffs are implemented within 30-45 days. Trading partners retaliate proportionally. Supply chain disruption materializes across sectors dependent on international manufacturing. Under this scenario, inflation resurges. Consumer price index readings accelerate to 4.8% by Q2 2025 as import costs transmit through the economy. The Federal Reserve faces an impossible dilemma: raise rates to combat inflation and risk recession, or maintain current policy and allow inflation to erode purchasing power. Market analysis suggests the Fed would prioritize inflation control, pushing the federal funds rate to 5.25 to 5.50% by mid-year. Equity markets would experience additional downside. Sector positioning under Scenario A demands a defensive bias. Consumer staples, utilities, and domestic-focused healthcare maintain relative strength. Energy companies with U.S. production concentration benefit from price support. Defense contractors accelerate on increased federal spending. Technology faces bifurcation. Semiconductor manufacturers suffer. Software companies with subscription revenue models and minimal physical product exposure demonstrate resilience. Corporate bond spreads widen further. Investment grade spreads expand to 140-160 basis points over treasuries. High yield spreads reach 450-500 basis points. Credit selection becomes critical. Companies with strong balance sheets, minimal international revenue exposure, and pricing power outperform. Leveraged companies in cyclical sectors face refinancing challenges. Scenario B, political compromise and policy moderation. Probability 45%. This scenario assumes political and economic reality forces policy adjustment. Initial tariff implementation occurs, but at reduced scope or with extended phase-in timelines. Exemptions multiply. Trading partners negotiate rather than immediately retaliate. Congressional pressure and business lobbying moderate executive action. This represents the highest probability scenario because it mirrors historical policy implementation patterns. Campaign promises encounter practical constraints. The business community, which provided substantial campaign funding, applies pressure through lobbying channels. Key Republican senators from export-dependent states demand modifications. Legal challenges create implementation delays. Under this scenario, inflation remains elevated but contained at 3.2-3.8%. The Federal Reserve maintains current policy through Q2, then implements a single 25 basis point cut in Q3 if economic data softens. Market volatility persists, but trending downward. Equity valuations stabilize at current levels with modest upside potential. S&P 500 fair value under Scenario B suggests 5,400 represents appropriate pricing, roughly 5-8% above current levels. Earnings estimates hold near consensus at $240-$245 per share. Margin compression occurs, but remains manageable for most corporations. Sector positioning under Scenario B favors cyclical exposure with selective international diversification. Industrials recover as tariff uncertainty diminishes. Technology regains leadership as supply chain fears moderate. Financials benefit from sustained higher interest rates, improving net interest margins. Small-cap domestic companies outperform large-cap multinationals as domestic demand stabilizes. Corporate credit markets stabilize. Investment-grade spreads compress to 110 and 130 basis points. High-yield spreads settle at 380-420 basis points. Credit market access remains available for quality borrowers. M&A activity accelerates as strategic buyers exploit temporary valuation dislocations. Scenario C, external disruption and forced policy. Pivot, probability 20%. This scenario assumes unforeseen external factors overwhelm policy intentions. Possibilities include severe trading partner retaliation, triggering supply chain collapse, geopolitical crisis demanding international cooperation, domestic recession forcing policy reversal, or financial market instability, creating systemic risk. History provides precedent. The 2018 tariff escalation with China forced agricultural subsidies when farm bankruptcies accelerated. The 2008 financial crisis forced policy pivots from both parties. External reality possesses veto power over political intention when consequences become severe enough. Under this scenario, market outcomes become highly path-dependent based on the specific disruption catalyst. A geopolitical crisis could trigger flight-to-quality USD strength and Treasury rally. A recession catalyst would force Fed rate cuts to 3.75-4.0% and fiscal stimulus. A financial stability crisis would require coordinated central bank intervention. S&P 500 valuation ranges under Scenario C span from 3,800 to 5,600, depending on crisis nature and policy response. Defensive positioning becomes paramount. Cash holdings of 15-25% preserve optionality. Gold and Treasury exposure provide portfolio ballast. Quality bias, companies with fortress balance sheets and recession-resistant business models, becomes essential. Strategic framework for the next 90 days. Professional portfolio construction under uncertainty requires scenario planning translated into position sizing. A balanced approach allocates capital across scenarios weighted by probability while maintaining flexibility for scenario reassessment as new information emerges. Recommended positioning for the 90-day horizon. 40% core equity exposure focused on quality domestic companies with pricing power and strong balance sheets. 25% opportunistic equity exposure ready for deployment if additional market weakness creates valuation dislocations. 20% fixed income split between short-duration investment-grade corporates and intermediate Treasury securities. 10% alternative assets, including gold and real assets providing inflation protection. 5% cash for tactical deployment. Critical monitoring indicators over the next 30, 60, 90 days will signal which scenario is materializing. First, tariff implementation timeline and scope. executive orders versus congressional legislation, exemption processes and phase-in schedules. Second, trading partner response, retaliation versus negotiation, WTO challenges versus bilateral discussions. Third, inflation trajectory, January and February CPI and PPI releases, core PCE deflator trends. Fourth, Federal Reserve communications, FOMC statement language evolution, Chair Powell press conference tone. Fifth, corporate earnings guidance, Q4 2024 and Q1 2025, earnings calls beginning in late January, management commentary on tariff impact, cost pass-through ability, and demand environment. Sixth, credit market stability, corporate bond spread behavior, leveraged loan covenant compliance, bank lending standards, surveys. Seventh, consumer spending data, retail sales monthly releases, consumer confidence indices, credit card spending velocity. The difference between portfolio survival and portfolio optimization in the coming quarters will not be determined by prediction accuracy. It will be determined by strategic positioning that acknowledges uncertainty while maintaining asymmetric exposure to opportunity. Markets that tremble create dislocations. Dislocations create mispricings. Mispricings create returns for patient, disciplined capital. The business community now faces a binary choice: react emotionally to volatility and crystallize losses, or respond strategically to probability distributions and position for multiple futures. The market has spoken. The policy has been announced. The institutional money has repositioned. The only remaining question is whether individual decision makers will recognize this inflection point for what it represents. Not a crisis demanding panic, but a recalibration demanding strategic thought. The next 90 days will separate those who preserved capital from those who destroyed it. The next 18 months will separate those who merely survived from those who strategically prospered. The market trembled. The professionals prepared. The choice, as always, belongs to the individual investor willing to think clearly when others think emotionally.